This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us today as we take a look at the market trade here on this Wednesday, it was another interesting day. We had new inflation data out into the marketplace. We have weather risk out in the grain trade and much more to talk about. Let's say good afternoon to our good friend Mike Zuzolo with Global Commodity Analytics joining us today. Mike, great to catch up with you again, sir. How are you?
Doing great, Jesse. Thanks for having me back.
I appreciate the time. Let's dive right in, not waste any time, Mike. I think to start, the CPI index out this morning, that headline inflation number, 9.1%, the highest in 41 years. Obviously, that was something that was going to be talked about all day long, although I don't think the grain and oilseed trade was as affected by it as I thought it was going to be, but still a very hot inflation number seen here today, Mike.
Yeah, it really was. And I think that the trade, I do believe, had some surprise to it when we saw, as you say, that 9.1% being the highest since November of 1981. I can tell you in November 1981, I had a full head of hair. So that's how long ago it is that we're talking about how high this inflation is. But I do think that the surprise to the upside in the inflation and the fact that the dollar broke lower, which is an inflationary indicator in and of itself, kind of indicated to me that this was a surprise enough to kind of bring in some short covering after, the essentially the WASD bloodbath we saw in price action in grains yesterday or on the prior day's trade. So I think you're right. I don't think it was as big of a factor, but I still think it worked into the mindset, the trade sentiment of short covering with the weather, especially the European weather. And now we're starting to talk a little bit more about U.S. weather, beginning to work into the row crop sentiment a little bit more. The other thing I'll throw in there, because I don't know if we'll have enough time to talk about it, the Ukrainian situation is actively moving. It is a moving target right now. The latest word is that next week there will be a deal signed to get grain out of Odessa. Odessa, as we've talked about, Jesse, is the Black Seas and the Ukraine's crown jewel for grain port shipments and storage. In fact, this week I found out that Odessa alone probably has around 18 million tons of grain in warehouses and in port terminals by itself. And so that's been the focal point in the wheat market, especially on and off throughout the last, 3 months that we've been trying to get this blockade lifted and this shipping lane open. It looks as though that's going to happen. Next week is when they're supposed to sign the deal. That really took the sheen and the luster off of the wheat, and that's, I think, why we closed lower on Wednesday's trade.
Well, let's stay on that point, Mike, and pivot there. And I know, thinking about yesterday's WASD release as well, those July numbers, it pretty much came in as expected. But you look at the numbers, you throw that with what you're talking about with Ukraine and that possible deal, which I've seen that news, as you mentioned, in the wire as well. I'll pull up the world wheat usage chart and on the video feed and talk to us a little bit about this and talk a little bit more in wheat, because this is something to definitely keep our eyes on. If we see some of that grain start to move out of Ukraine, if a deal is reached, what is that going to do for price action and charts, et cetera? So walk us through a little bit more what you're thinking and what you're seeing in wheat after the July USDA numbers.
Yeah, the key with this report and the key with the market sentiment, and I think the key to help the farmer and rancher, especially those struggling with terrible pasture and range conditions or a drought that hasn't alleviated itself, or a cattle lot that is going to be maybe 110 degrees next week. The key with this recent market has been the idea that we're going to have demand destruction. And USDA's report gave us that to a degree. I think it satisfied the needs of the demand bear, the recession bear, the strong dollar bear, the China COVID bear. That's all wrapped up together in the idea, Jesse, that we're not going to have the grain demand. And the export data recently has shown that. And that's, again, a big difference between the grains and the livestock and why they've separated out. And it's not as though commodity index funds are just buying agriculture indexes by themselves, and because that's both grains and livestock. They've parsed it out and they've bought the livestock and sold the grains. But this chart shows you that we were down about 1.8 million tons from June in world wheat usage. That's about the same amount that USDA took us down in world total grain usage. And so when I look at this chart and I see that they've taken us down about 6.3 million tons from last year now, I think to myself, we've taken soft red wheat down almost 45% off of its highs. I would think that's done enough damage and should encourage enough demand with that kind of a price break that wheat is still my leader. And indeed, the bright side of the WASDE report yesterday was the wheat, was that USDA increased the exports for U.S. wheat by 25 million bushels, suggesting we have seen a price break enough that we're attractive, especially given that they cut the European Union and the Ukrainian production by a total of 4 million tons. That's a big number, especially when the trade has been under the assumption that the Ukrainian grain that's been held up will be compensated for by increased European shipments. That's no longer as easy a thing to see as what they thought after the USDA WASDE numbers. So to me, especially when you integrate the Ukrainian situation with the shipping lane and the US dollar, I think the wheat still is my leader to forming a bottom first.
Well, and forming a bottom is something we definitely need to find here, Mike. And I wonder if we have found it or not. I think there's some question about that in the trade, especially just considering all the chart damage we've done in the last week or so. I think since last time we've talked, we saw that big sell-off, the fund liquidation, et cetera, and now a little bit of a bounce back, minus yesterday, of course. But I wonder with wheat, corn, beans, have we found that bottom yet? I think it remains to be seen. I'd love your thoughts on that.
Yeah, this is where it's going to be really tough navigating. But, we talked about this, and I think we've got a graphic of the CPI and a Bloomberg article headline that came out on Wednesday afternoon that they're now in the trade because of this 9.1% CPI data number. Jesse, they're now talking about the Fed going to a 1 full percentage point increase this month. Well, this month means late in July. It's not like the Fed meeting is the same week as the WASDE report like it normally is. We have to wait until the very end of July, essentially, to get their comments and their actual policy. The trade had baked in, as we got the WASDE report, probably 3/4 of a point hike, with the idea that the Fed would back off really aggressively and say, okay, we've done all we're going to do for a while. We're going to sit back and watch. Why would they do that? Well, the data and the economic points that are key suggest they should. Plus, they realize that it takes 3 to 6 months for their policies to actually get into the real economy. So if you're looking for a 1.5% increase in interest rates over the course of 60 days, you're going to need to wait until September, October to see exactly what that's done to the real economy. But this Bloomberg headline, and I've seen it in the Financial Times now as well, is suggesting, well, the inflation's so red hot that the Fed's going to, supercharge this rate hike this month, and they may come back again and do something in August or September. That's my fear. And so I've really talked to clients sincerely about the idea that copper led us lower, led the wheat lower especially. The dollar led us lower. So unless I would see a dollar high and a copper low, and that would come together with a wheat low in terms of price low, I'm going to wait. I'm going to wait until we see what the Federal Reserve actually does and says about future policy, and then see if that doesn't bring a low in. So I'm going to say another 5 to 7% down is possible. I don't think we should take out our July lows given the WASDE report. But by the same token, I want to see what the Federal Reserve says. So I'm going to say 5% lower, then maybe I'll start looking at longs. Otherwise, I'm going to wait for the Federal Reserve towards the end of the month to start to kind of signal the all clear. Obviously, I'll have one eye watching the weather.
Very, very true. You read my mind when you sent me that article too today, because I saw the same thing, and I think that's something to watch closely. And as well with this dollar, it's been spiking. I know, I believe it was yesterday, the dollar and the euro came together for the first time in 20 years. There's just a lot of interesting dynamics going on right now in the outside markets that are having an effect on commodities, Mike.
Yeah, and this is where the soybeans come into play. And you and I've talked about this a lot, is because soybeans equal China, copper equals China. The problem with China right now is we think that it's a pretty rough economy right now, so rough that they're willing to throw $220 billion at stimulus through tax breaks and also through bonds for infrastructure. That's a huge number for China. 220 billion US dollars is huge. And so when you talk about the stronger dollar and the parity between the euro and the US dollar and the weakening of the Brazilian currency and the weakening of the Chinese yuan, that all goes right back to the COVID policies of China. And it all goes back to the Federal Reserve policy of tightening and fighting our inflation battle here. But I think China's economy is actually worsening at this point, not getting better or stabilizing. And I say that because Bloomberg also reported this week that about 22 cities are seeing owners of mortgages not pay their mortgages anymore, totaling, I think it was about 86 or $83 billion in mortgage payments. They've stopped paying their mortgages because real estate values are plummeting and project delays are being seen around the country. And this is coming from the big banks like the Citis and the JP Morgans. They're seeing a real problem with the real estate sector. And it shouldn't surprise us because of what happened with Evergrande and some of these other companies about 3 or 4 months ago. Well, now finally that ripple effect is coming into the real market and to the real Chinese consumer. And I think we're really on a precipice of seeing a real possible severe economic slowdown in China if we're not too careful here. And I don't think we've really caught up with that. And I think USDA's data yesterday of pulling down the Chinese imports of soybeans from 99 million to 98 million metric tons was a big wake-up call to the trade.
I would agree, and that is exactly where I was going to go next, Mike, with our conversation, is talking about those USDA numbers on the soybean side in China yesterday. And, we've heard more and more reports about the Chinese selling out of their reserves and not buying U.S. soybeans or buying beans on the world market right now, maybe waiting for prices to come down a little bit. But, we talk about this Chinese demand, and to all of your points, if their economy is in trouble, what is that going to do moving forward? And I thought this was very interesting to see on the USDA report yesterday.
Yeah, and you see in that commentary below that chart that the imports and consumption of oil seeds and veg oils have fallen short of expectations. And see, this is where we have this premium in the market in the soybeans, I think, Jesse. One premium from the trade that thought we were only going to have a Brazilian bean crop of 115 or 120 million metric tons. Well, it's clearly going to be 124 to 126, in my opinion. So there you have, 7 or 8 million metric tons on the supply side that you haven't priced in yet. And now you go back to China. What if they do drop from 99 million tons to 94 million tons? That's only a 5% drop. And that's not a big drop when you look at it over the course of the last 4 actual years of marketing year imports. And so 94 million metric tons would be 5 million tons on top of that. All of a sudden, with 100 million metric ton ending stocks number here in the world right now, as of USDA's report, 99 plus, you add another 10 million onto that, and all of a sudden you're talking about almost 110 million metric tons. And so the COVID restrictions cannot be overemphasized as far as what they're doing to the Chinese economy right now. And I think I'm actually worried at this point that 2018 levels of imports are not off the table. In other words, I could see where we end up not doing much better than 85, 86 million metric tons of imports because their hog industry is smaller than what they want it to be net, and because of what's going on with this demand, this consumption base, if it's eroding. Remember, the real estate market in China is kind of like our consumption in the economy of the United States. It makes up around 2/3 of the economy for the domestic economy in China. So it's almost everything when it comes to not having a slowdown. And if they have a rough real estate market, they'll pull money out of their banks, they'll stop buying real estate, and all of a sudden you'll see the Asian equities even get sicker than they've already been. And that's what we have to really plan for in our marketing plans. And I think soybeans are on the front line with that.
Corn market real quick as well, Mike. I've heard some rumors, speaking of China, about them maybe buying some cargoes here soon. Who knows what that will look like if it does materialize, but you see corn right now hanging around the $6 mark in new crop. Any thoughts with just how this corn market's been looking and performing here since we started the week, got through the July WASDE report, et cetera?
Yeah, I think corn and wheat still have less competition out there than the soybeans when it's all said and done. And I think also, Jesse, when I saw the USDA give us a 665 average cash price, we went down to about 565 in December futures for a low. You take 30 cents of basis off that, you're talking about 535. All of a sudden, you're $1 plus $1.30 underneath the average cash price as of the recent lows. And so I think the corn, because of the wheat, has gone into an undervalue mindset. And I'm actually looking at feed needs getting covered here in the not too distant future, depending on how this high pressure sets up in the Western Corn Belt or doesn't set up, and whether this Ukrainian deal goes through or not. So I'm really on edge to get some feed needs locked in for producers on new crop corn, for cattle ranchers on new crop corn, because I do still think it's the most undervalued. And I had several conversations with clients this week on their corn. It's a short crop. Our silking is way behind. Obviously, blooming for soybeans is behind as well, but I'd say we're 2 to 3 weeks behind still what we normally are. And so a ridge of high pressure can do a lot of damage. I think the biggest thing to watch for corn in the very short term related to the supply, related to the weather, is watch the Iowa crop conditions. The fact they went up 4 points to 81% good to excellent this week, I think really took the sheen off of the possibility for corn to find extra support and some extra short covering. I think the trade historically really cares mostly about an Iowa drought, not necessarily a Kansas drought or even an Illinois drought. They really care about Iowa and Minnesota. And that's where this weather is really key for the positioning of how we look at this corn in the next 30 days.
Mike, I want to segue our conversation to livestock, but I'm also going to pull up on the video screen the average prices. You mentioned for corn, the July numbers coming out, and it's got the cattle and hog numbers there as well. If you want to make mention of these real quick as we segue to livestock, because great points as far as maybe locking in some of those feed needs here with the way corn is looking right now. But talk about this a little bit as we segue to livestock, Mike.
Yeah, the big point here is that if you look at all those numbers, look at the futures prices, especially for new crop corn and new crop beans, we're already well below those average prices. And so this works into my narrative and my analysis that I've been sharing with you for several months now, that I'd rather be in the futures market hedging than in the cash market hedging, because there's no premium in the cash market at this point. And I think that's where the cash market has more ability to withstand knocks, whereas the investors can really play havoc in the futures market. And so that's happened. You know, we talked about this probably 3 months ago. That's what's been happening. So stick with that program. When we get ready to hedge, do more bought puts, do more paper positions as opposed to cash related positions, unless you have just a terrific new crop basis.
Livestock today, cattle and hogs, especially feeder cattle, again breaking the upside some more today. Hogs looking strong. Fat cattle just kind of felt like they went along. What are your thoughts with the futures trade in the protein sector today, Mike?
Yeah, the USDA was very good and giving to the livestock sector. It fed the idea that the funds have been working with, that we've not lost any demand. In fact, USDA increased beef exports and they kept the beef imports the same. And so we really don't have any demand destruction in the USDA WASDE numbers when it comes to the livestock, and we continue to be threatened with supply issues. I think the hog market especially has been able to find a lot of support off the African swine fever in Europe. That sounds like it's spreading out into different countries, very big, important countries like Germany, a huge hog producer for Europe. So I think the lower supply, strong demand, even with the 20-year high in the dollar, has really kept the funds involved on the long side in the markets. Now, at this stage, Jesse, I think we've got to start thinking about premium and basis. We've got the feeder cattle futures $9 over the CME cash index. So we got a big premium in the feeder contracts, whereas it's the exact opposite in the fat cattle. If you use a Nebraska fat cattle price of 145 in the cash market, and you've got the futures market at 137, 138, you've got a substantial discount in the futures market as we head into what I think is a weather bowl drought in the Southern Plains. One of the things that is really concerning me are these temperatures that are going to be, maybe we're going to be seeing in feedlot country in the next 10 days.
Couldn't agree more. We touched on a lot today. We could have probably talked a lot more about the weather too, but I think that's a developing situation we just have to watch. Mike, before we run out of time here, any other final thoughts you have for us today?
Just pick up a trial. I think it's a really good time. I say this frequently, but I really do think this is a very good time to take a look at going to globalcomresearch.com and picking up a 2-week trial and seeing if some of this macro micro mindset can't help you in your marketing plan. I really try and bridge that macro and micro commodity analysis so it makes more sense, hopefully, when you make your decisions in your ag side.
Globalcomresearch.com. Com has 2 M's in it. Globalcomresearch.com. With that, Mike Zuzolo, always a pleasure, sir. Have a fantastic week. We'll talk to you next week.
You too, Jesse. Thanks so much.
Mike Zuzolo with Global Commodity Analytics. That's going to do it for today's episode of Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.